Good morning, good afternoon, and good evening to everybody out there, and Ramadan Mubarak to all of our friends celebrating Ramadan this month. I'm Rustin Edwards,
Yes.
based in Geneva, and with my esteemed fellow world traveler, Matt Stanley in Dubai.
Morning.
Good morning
Happy
to you, Matt.
Sunday. Morning, everyone. Sunday, 11 o'clock. I'm not in the pub. It's nice, isn't it? This
You're not on the
podcast is
golf
good for my
course.
health.
And you're not on the golf
No,
course.
I know. Well, it's only because I got blown out, so I thought I'd talk to you instead.
Ah,
No, I'm only joking. No, Ramadan Kareem to everyone. It's a lovely morning, Dubai, 28 degrees, quite a bit going on. But yeah, thanks again to everyone for, commenting and subscribing and liking the videos. We're aiming to ramp things up and keep things as they are, but we really appreciate it. So like, comment, subscribe, keep doing that, and we'll keep on bashing the poddies out to you.
so let's get going. What's smoking on the barrel today? What do we have out there today? Got a little bank crisis, got a little supply and demand.
Certainly is, isn't it? I mean, I don't know. I mean, we don't have to be that old to remember that it was probably, 2008, 15 years ago, the last financial crisis we went through, the last banking crisis. There are some unsettling kind of similarities, I've got to say, but I don't know. What do you think? What's smoking your barrel?
I mean, I think that when we look at the general economic conditions of the EU and the United States, as well as in Asia, some of the interesting data points that came out last week was the PMI numbers. And if you looked at the overall PMI for Europe, United States, and the various countries inside the EU, as well as some countries in Asia, you see that the overlying PMI numbers are fairly strong, showing growth. But when you start looking at the split between the services and the manufacturing sector, services is where all the growth is coming from. So there's definitely been a divergence where you've got the service sector growing, supporting the general economy, yet the manufacturing sectors are in contraction, which is fairly negative for energy demand. Because when you think of energy demand and manufacturing, that's probably where the majority of your energy demand sits within every country, is in the manufacturing sector, not in the service sector. Yes, service sector, you have jet fuel, you have some trucking, and you have electricity. But your big heavy hitters are your factories, your refineries, and everything else which produces goods through manufacturing. And with those contracting, that doesn't bode very well for forward economic growth prospects.
No, and you know what? I would hazard a guess that it's all to do with the public being made very aware of just how high inflation is. People are no longer, I would say, people are getting about and doing what they have to do, but they're not buying new patio furniture. They're not buying new barbecues. They're not buying. I think it's very much a story with things getting more expensive, which they have. UK inflation was out this week. It was 10.4% or something.
Yeah.
And
surprise uptick.
Yeah, and then you look at what's happening with interest rates. So people are going, stuff's getting more expensive, and it's getting more expensive for me to borrow. So I think that might be the theme of the year. For the rest of the year. I mean, we're nearly through Q1 now, 26th of March today. I think that will be, the world is approaching things cautiously. And I think for manufacturing PMI, I think those numbers need to be looked at carefully. But yeah, look, I mean, I don't know. I mean, speaking to a lot of people this week, the US, what Jay Powell, what he did with his fiscal policy and, what's happening there. And of course, here in the Middle East, with a lot of currencies pegged to the dollar, dirham, obviously where I am, is pegged to the dollar, 3.6725. So fiscal policy moves, the central bank moved with what the Fed does. So here it's 4.9% is the base rate. My wife's a mortgage consultant, and it was only a year ago that interest rates on a baseline were like just under 0.5. So has that dampened demand in the UAE? No, but I think that's the UAE is kind of a different story there. But what's happening globally, like you said, with the manufacturing PMI, there is some divergence that will need to be addressed at some point.
And despite, even with the U.S. raising interest rates by 25 basis points, that was followed on with ECB and the Swiss National Bank both jumping up 50 basis points. So generally, your cost of financing of inventories, cost of goods, and your feedstocks are all going up on top of contracting in demand, which doesn't bode well for the manufacturing sector, at least for the next quarter. Because when you think of the purchasing routes that everybody has to go through when you're buying your raw materials to your factory throughput, it's not that you're buying stuff tomorrow for Tuesday manufacturing. You're buying stuff usually with a 4 to 6 week lead time, and then you have to figure out how to finance those goods as they go in through your system. So nevertheless, and conversely, when you look at how are freight rates attributing to the manufacturing decline, you still have container rates 83% below the peak back in 2021 for a 40-foot box worldwide. And it's still 35% below the 10-year average for a 40-foot box. So, freight rates are not showing any resurgence in demand just yet. So consumer goods are still going to be, I think, the tailwind, or not the tailwind, they're going to be the anchor dragging the economy lower. And
look, containers was it 2 years ago when the world was locked down? I think about that now and what it was like, and I'd never heard the sentence, "Dad, can I have a snack?" so many times in my life. I was going to go mad. Even now, it just sort of come on. But it was 2 years ago. But the container freight rates went mad because China was, and only up until recently, China's sort of is slowly opening up. So it was more people couldn't be in the places they needed to be. So container ships weren't in the places they need to be. So of course, the demand supply, balance was completely out of whack. So you can argue that were container freight rates justified being where they were on global balances? Probably not. But if you look at other freight markets, which of course better than anyone, tankers are doing very nicely, thank you.
Well, the tankers are still just a reflection of the divergence or the bifurcation of the market between those engaged in the Russian flow and where the Russian flow is going on longer haul voyages than where they have been historically in the past. And you've got more imports coming into Europe on longer haul voyages more than there were in the past. So therefore, you have longer ton miles on tankers, which is benefiting the entire tanker industry. Where containers, back when the container rate spiked back in 2021 and early part of 2022, there was a definite problem around the box boat industry because boxes had stacked up all over the world and weren't in the right location in order to facilitate the transport of goods through a container box. So once the boxes got moved around, rates started to come off. And now you've gotten to a point where there is no more of a demand pull because most of the stimulus money that was passed out in the West has been spent. It doesn't exist anymore. And so now people don't have that extra bit of cash to go out and buy that TV or buy that barbecue, or they've satisfied their demand because they did buy the TV and they bought the barbecue, and nobody wants to have 6 barbecues in their backyard. So
I've got 6 in my backyard,
and you've got a pizza oven too.
Yeah. Don't knock. I know I may have an illness, but I like collecting barbecues. Thank you.
But no, that's where we're at. And so when you look at container ships, I believe the number I saw quoted was about 150 ships are laid up. Container box boats, mainly non-scrubber fitted ships. And voila, you've got a collapse in the market.
I'm wrong there. It wasn't 2 years ago we were locked down. It was 3. I've lost a whole year of my life just in the last 2 minutes. It was 3 years ago. Of course it was.
That is the COVID effect.
Yeah, that is the COVID effect. But just what you were saying about Russian energy exports, just quickly about the freight. March 2023, we've seen 267.8 million barrels of Russian energy exported. That's this year. Now, March last year, it was 216. So, like we were all saying, Russian energy energy exports have not been curtailed. They are increasing. Whether that will continue into April, I don't know. But
that kind of goes into the face of the Russian energy minister statements of the 500,000 barrel cut. Because
Yeah.
if that cut hasn't happened yet, or if it has happened, it just hasn't translated through the supply chain. That could also be what's going on. Because the one
Yeah.
question that I think on Russian energy exports is how much is sitting in inland storage that hasn't been shown to the market, because the data around what does inland tankage look like is a very tight knit closed piece of information. And now that we're going into the spring, you're going to start seeing river transportation pick up, which will be far more efficient than the rail transportation. And so that could help surge out some of the stuff sitting in inventory and draw down their stocks internally. And then maybe we'll start seeing a decline in exports in relation to whatever production cut they announced over that, and also
Yeah.
this extending them into June.
Yeah, I mean, I think I wouldn't say it's taken people by surprise, but if you're a neutral and you're not involved in the energy markets, we love you. Make sure you like, comment, and subscribe. I think it would come to the neutral as a surprise, because the EU, the US, and all, the G7 who got together regarding Russia have decided, the US made it clear that they don't want to ban the world from Russian energy. That's where the price cap came in. They very much need Russian energy. But an increase year on year of 20% in Russian energy exports, that would raise a few eyebrows by the neutral. Perhaps those in the energy market are not surprised. I don't know. But anyway, I mean, talking about things that may surprise you, Rustin, banking crisis for you, please?
Banking crisis?
Is there a new banking crisis?
I mean, is this, are we all sitting back watching the slow motion train wreck of the world financial system as Deutsche Bank, on Friday rattled the markets, and not by anything that Deutsche Bank did, but just people starting to buy.
Listen, mate. Listen. You started it. The Swiss started it with Credit Suisse. So don't talk to me about the Germans.
We all know the Americans started it with
here we go. So it's still you. You're American sitting in Switzerland. You are the problem.
The interesting thing with banking at the moment is that when you look at the U.S. Federal Reserve overnight window, they've been exceeding $95 billion, which is almost equivalent to what they were doing during the financial crisis and during COVID. So it tells you that people are, banks are worried or taking on short-term loan exposure to help manage their cash flow. And then when you look at the special bank term funding program that was set up after the SVB and Signature Bank collapse, that started off at 11.9 billion last week. Now it's up to 53.7 billion in short-term loans that are guaranteed by derivative assets that may or may not be marked to market below face value.
I mean, it just seems to me to be another managerial nightmare that I think that people haven't anticipated potential problems, haven't put it into their mark to market properly, haven't recorded it on the balance sheet correctly. I mean, this seems to me to be another, a sleeping giant, if you like, of problems.
Well, I read an interesting article, I believe it was on Bloomberg, where the comment was, 2008 was the subprime mortgage issue. What we're experiencing now could be what's called the super prime issue, where you've got high net worth individuals, large companies who park their money in certain banks because the banks wanted to tend to the higher net worth individuals because they had liquid assets, they had the ability to invest. Therefore, they provided a much more stable deposit base than the subprime groups. And they gave so much because there were more fees to generate through people trading stocks, doing investments, going into investment vehicles. And so there's a lot more money to be generated from the high net worth individual than the lower net worth individual. But the problem that the banks have established is that with interest rates going up, the high net worth individual is smart. If they're parking $500,000 with a bank or $1 million with a bank, and now somebody knocks on your door and says, "Hey, tell you what,
I don't know.
I'll give you 5%."
Donald Trump's a high net worth individual, so
let's not go down that road.
I'll miss him. Go on, sorry, interrupt you.
But with people who are more investment savvy, If somebody offers you a much higher interest rate return on your investments, you pull your money and you go somewhere else. And this
Of
is
course.
where a lot of these medium-sized banks have a problem, because when they laid off their risk down the curve um, in long duration maturity bonds, and the high net worth individual says, "Hey, you know what? I'm withdrawing all my money today, and I'm going to go over here." Now they have to liquidate, and they can't really liquidate, so they end up in this squeeze where they don't have they end up in a liquidity squeeze.
Yeah. I mean, how is, yeah, totally. I mean, look, I think there is a lot more to this story. I mean, when I have to say the Swiss National Bank managed it very well. I mean, that really could have got out of control. And, you know, it was this time last week, there was obviously they were, you know, having Sunday lunch together and, okay, how do we get ourselves out of this? And they called up their mates at UBS. How is it being received in Geneva? Is it discussed? Was it writing was on the wall, so it was inevitable, or is it sort of shaking the fabric a
Well,
little bit?
I think here in Geneva, Credit Suisse was always known to be have a problem from all the issues they had through their different trading relationships, which all ended up causing some type of scandal or another. I think here in Switzerland, I think there's a lot of people who don't like the idea of having a singular massive bank as in a UBS. And so there are
Okay.
people petitioning to have certain entities as Credit Suisse spun off and kept as Credit Suisse. For instance, I'm going to call it the retail banking division that dealt with people's deposits and mortgages. That was actually a very profitable division within Credit Suisse. It could theoretically stand on its own. It's
Right.
all the other stuff that was causing Credit Suisse problems. The commercial trading, the investment packages they were putting together. All of them had some hair as people were finding out with all the scandals that have popped up. That's what was causing the downgrade or the degradation of Credit Suisse as a bank. So it's still, I think the Credit Suisse UBS story is not done yet. I think
Right.
that there will still be some shakeout that happens there, because if the Credit Suisse populace want to see a much more diversified banking sector here, they're going to put pressure on the parliament to push things out and make it more um, clear as to how the banking system is going to be set up from this point forward.
Yeah. I mean, look, it's I've got a good mate in the UK who he retired from Credit Suisse about 5-6 years ago. He made a lot of money there, and it was a very successful bank and operating out Canary Wharf. So I'm sure they'll be fine. I mean, look, I think you're right. I don't think the story is done yet, but they've managed it well in that it's no longer, front page news. It's kind of in the business section, tucked away a little bit. But I don't know. It's how is it being felt across the rest of the world? I think that's still a bit early. I mean, look, I think the Saudi PIF, or one of the holding companies of the Saudi, one of the big Saudi funds, held 10% of Credit Suisse. So there will be hits. It's it's a the tentacles spread far, right, on a crisis like this. I mean, it's a difficult one. What does it mean? The macro basis, of course, everyone's a bit frightened. Markets came off. Brent was no exception, or the old energy complex was no exception to it.
Well, I think it's more risk assets were no
exactly
exception to it.
It was a sentiment. It was a sentiment thing. It was like, oh shit, sell all that, and I'll take a little bit. And it goes to show you who's invested in the oil markets. It's the funds and the props, etc. But what does it fundamentally mean for the energy markets? I mean, look, the energy markets haven't relied on a financial institution for a long time now. A lot of it is, trade finances and things like that. There's no exposure to energy really anymore.
Well, I would beg to differ, is that with increasing interest rates and banks getting into more and more difficulty around how they can utilize their liquidity on their balance sheets, I think what it does for energy markets is it does reduce the ability of smaller trading entities to get trade finance, because they become a higher risk allocation versus your bigger trading shops, your big trading houses. I mean, your oil majors have always been self-financed. I'm sure Aramco trading is self-financed, but when you look at the likes of a Vitol, a Trafigura, a Glencore, they all rely on external third-party financing lines, as well as every other subsector business. And so it's those subsector businesses with those extended credit facilities that are going to start feeling the pinch, especially as the rates keep going up. It just starts making that cost of moving the cargo from point A to point B that much more. And it's not like you're receiving an incremental higher margin because your financing has gone up.
Totally. I mean, your TVM, your time value of money, that has roofed, and that will have to be put on as additional margin on the trade. So it will go to the end user. I'm not trade finance.
If the end user is willing to pay for it.
Well, then we'll go. So there is a far-reaching issue here behind it all. But I'm referring to fossil fuel exploration. Putting a well together. A lot of the banks, especially in the US, are not interested in that sector anymore. Which is funny because one of the things I wanted to talk about today was what's happening with US energy exports. Grandpa Joe has been fairly quiet on his energy policy recently. In fact, I would argue during Cera Week, after IP Week, it was a big week in Houston where, the sort of energy circus moves over to the States. Very well attended, candid conversations about how people can are getting their energy. I mean, the one thing that people were worried about, obviously, was what's happening with Russia and what's happening in the EU. US energy exports this month are at 237 million barrels. Now, if we go back to March 2021, 2 years ago, it was 153 million barrels. So these are record US energy exports, and the majority of it.
I think you have to go back to 2019 data though, because 2021 you still had a lot of.
Yeah, I don't go back that far. I've only got 2 years worth of data in, mate.
Yeah, because in 2021, U.S. internal production was all the way down to just under 11,000 barrels a day. So there was the big drop off that happened during COVID that only slowly started to recover through 2021. So the amount of available volume for export was not that high. The U.S. right now has been averaging roughly around 4,500 to 5,000, 4.5 to 5 million barrels a day of exports, which is fairly robust considering the amount of production at 12.3 million barrels a day based on the latest EIA data report that came out last week. So the demand for U.S. crude has gone up, and it's probably going to maintain because Europe needs crude, and since Russia is no longer supplying crude to Europe, the next biggest available supply is the United States or West Africa.
Yeah, I mean, so we've got. I mean, I asked this question internally the other day. We've got a great crude analyst in the States called Matt Smith, who's always on the ball when it comes to this stuff. I mean, he sees the production in the US is going to average about 12.5 million barrels a day, which is up from 11.9 million barrels a day last year. I mean, it depends. I mean, look, Brent WTI spread, does that encourage people from the EU to bring in US oil? Of course it does. But there's also some profiteering here as well. The main crude oil producers in the States are not stupid people. And they're seeing an opportunity. There is a market to be grabbed there from what's falling away from Russia, and it looks like the US are the first ones to sort of throw the hat in the ring and say, have some of Texan's finest, mate.
Well, that's also again supporting the tanker rates that we see in the market today, because there's a far amount of oil shifting from U.S. Gulf Coast into Europe on larger tonnage. So that flow is moving, and it's probably going to maintain throughout the rest of the year. Especially as you now have WTI becoming part of the Brent assessment.
Yeah, we were talking about this as well. I mean, I asked that. I mean, I wondered if that was because WTI are going to be part of the dated Brent pool. I mean, for those who are not initiated, the uninitiated, what we're referring to here is the basket of crudes that go into making up what's called the dated Brent market, which is the physical side of the Brent oil market. And there's four, right? Brent, Oseberg, Ekofisk, and Forties, right?
Yep.
And now there'll be, and they're all Norwegian and North Sea crudes. And now there'll be an American one coming. Come on, come over here, you come bring your 4,000 miles worth of freight with you, and you can come and be part of the dated Brent market. But how it's actually going to be rolled out seems quite ambiguous. And I don't know. We'll have to see. But no, I mean the US certainly ramping up. I mean that I'm gonna keep my eye on that, intently, because, like you say, it's higher ton miles. What does it mean for the end user? I mean, obviously we read the stories this week about what's happening in France. I mean, more protests. I mean, I hope everyone's safe. It doesn't seem like there's any injuries or anything perilous. But the set fire to the Bordeaux town hall. I mean, leave it alone. Leave it be. I mean, it's 62 to 64. They're raising the pension age, and everyone in France has gone bananas.
Well, I think the whole reason why you have the protest is that, yes, you have an increase in the pension rate, but it's just how the whole thing was done through basically government fiat, not through the legislative process. And that's what I think is the big reason why things have stirred up as much as they have been. But nevertheless, you've got rolling refinery issues, rolling logistics issues around the country. So net, you've probably seen a decrease in demand for refined products by about, I would say, anywhere between 500 to 600,000 barrels a day across the regions, just because truck drivers aren't driving, people aren't driving their cars, and factories are not running at full tilt because people are on strike and protest.
I mean, we were one of my colleagues in Vienna, Victor. He was part of a story that Bloomberg ran regarding what's happening, the French oil strikes and all that kind of stuff. I mean, it's all linked, and the story started because, again, it's down to this energy crisis that hasn't yet materialized. A lot of people, when they were thinking about how European refineries were going to wean themselves off Urals crude, the Russian graded crude, that the majority of European refineries were built to run off was Urals. People have been buying West African grades, Nigerian specifically. France were buying 110,000 barrels a day of Nigerian crude. And because of the strikes, they're not buying them anymore. It's a big, it's all one big moving system. So Nigeria apparently bereft of buyers right now, which is a dynamic I certainly didn't see coming. Granted, it's like you said, it's because the refineries are down because of the protests. But when and how that gets sorted out, I don't know. But yeah, it's the latter half of Q1 was really, I think, a lot of people have looked at the real data that's coming in and gone, okay, look, it's nowhere near as bad as we feared.
Well, from a demand standpoint, or from a
supply?
From a supply, from a supply standpoint. No, energy supply is actually not being too bad. There have been some hits, but as pointed out just recently, you've had the Turkish government shut down the exports of KRG crude oil through the Seyhan pipeline, which is going to be anywhere between 350 to 400,000 barrels a day of exports are going to be impacted. That was kind of a late breaking piece of news over the weekend.
That was coming yesterday. It came in Friday night about this arbitration ruling in favor, and then Turkey came out yesterday and said they've shut the pipeline already from flowing that Kurdistan, the KRG barrels through.
And they won't allow any exports unless Baghdad gives them the okay to export it. So they basically put the ball firmly into Somo's court. Which then hopefully that will spur on and finalize the negotiations on the oil export policy that Somo's been trying to push onto the KRG for the last couple of years. And if it does, then
that's not a quick fix. That is not. I mean, I've got some very close friends who are Iraqi, and they talk about two things, and that's oil and politics, and those two topics are closely aligned throughout the Middle East, but especially in Iraq, which is still trying to recover from the 20 years ago Saddam I was overthrown. But I mean, what do you think? I mean, it's Sunday now, Sunday 26th of March, 11:30. Brent closed down $1.67 on Friday at 74.24. Does this supply disruption cause it to wake up in the morning and roof?
Well, it did rally up after the close, and I think it was probably because of this headline that came out on Friday. So when you look at where it ended the day at post close, it was up closer to $75 a barrel.
Right.
But does that actually make the market roof? I doubt it. Because I think 400,000 barrels a day of lost production, or not. It's not even lost production. It's just not able to export out of Seihan,
Yeah,
which
it's
is
shut
far
in. Yeah.
easier export than the southbound route for KRG. But nevertheless, you also have 500 to 600,000 barrels of demand destruction currently in the French refining sector.
Yeah.
So
Yeah.
from a macro position, it's kind of a eh. I think what it does do, though, I think it does put some more upward bias if you want to start digging into the barrel on the residuum side of the barrel, because the KRG crude oil had a heavy fuel oil cut. And so if you're losing that flow, that should definitely, in my opinion, you'll probably see high sulfur fuel cracks go even stronger from where they're currently at. And you'll probably see a steeper backwardation in the high sulfur fuel curve as well. Because if you're losing
Yeah.
400,000 barrels of, if those barrels aren't easily moving into the European refining sector, because that was the easiest outlet for Seihan, was to go into Europe,
Yeah.
which was
MOH. Yeah. Iplom. Yeah.
and now you're moving everything via the Gulf, which adds an extra 10 to 15 days of transit time. High sulfur should become a very strong market tomorrow.
Yeah, I'm not. I mean, infrastructure-wise, trucking that crude down. I just don't see. I think to be honest, it would be a fair assessment of how oil traders are looking at the market. Is there still the concern regarding supply disruptions? So 400,000 barrels a day. What's that worth? Is that worth $2-3? Does that mean, like you said, high sulfur cracks go bid?
From a trader's perspective, how can you say it's worth that from a supply and demand, because you don't have demand in France?
No, I know. That's what I mean. But what wins the battle? Is it concern because the French refining strike? I would like to think in one of the world's most developed democracies that they should be able to get around the table and sort it out fairly quickly. In Macron, I trust. But if we're talking about the supply issue, don't write in. All right, he's all right, Manuel. If we're talking about the supply issue, I think market is more shit scared about supply disruptions than they are about the odd pop in up and down on demand. I genuinely think that's the way the dynamic of the oil market has been for a while now.
I would say look at the reaction that the market had when the whole Seihan pipeline was offline at the earthquake. The market did spike, and it came right off as soon as flow started again. The issue around KRG is a political issue. Does it get solved easily? It could be solved, as far as we know, it could get solved on Monday. People sit around the table, say, okay, we agree, done, and away they go. Because remember, it is at least from the readings of the articles, they won't export Iraqi KRG crude without Baghdad's consent. So if Baghdad says, go ahead and let those cargoes go, okay, then you really have lost nothing to the market.
Yeah. Okay. Look, I mean, let's see what happens. But I mean, I'm of the opinion that Brent probably wakes up $1.50, $2 up tomorrow.
Well, it said it jumped up $1 after the close on Friday. But we probably see another rally in the morning, and then as people assess the actual data, they will probably pull it back again, because is it really that bullish, or is it just a political thing on top of that, the financial issues with banks?
But the Bulls never need much of an excuse. I agree. So what are you seeing a week ahead? What are you having a look at?
Well, I think in the week ahead, I think the most, from a financial market standpoint, the biggest data point coming up is the Chinese PMI data coming out on Friday. I mean, that's going to be a window into the soul of the Chinese manufacturing. Granted, this is from the National Bureau of Statistics in China. It comes out it's for the March reading, so I think that's going to be important. We also got a lot of inflation data and economic sentiment data out of the EU. Which is also going to be very important to read, because that's just going to keep developing. How are the consumers reacting to the high inflation, as well as to all the other issues popping up around the EU? Because cost of living crisis hasn't gone away. I mean, the other thing that I think is going to be interesting to watch from a supply and demand standpoint is you've got the UK offshore workers who basically the guys who run the oil fields in the North Sea are currently in a labor negotiation for their contract renewal, and they're calling for a general strike starting on Thursday.
Right.
That could actually impact North Sea crude production because it's 1,500 workers that are covered under the collective bargaining agreement, which basically service all the offshore production facilities. The union has already stated, at least in the last article I read on this, that they would have a rolling strike, so they wouldn't shut down all the fields at once, but they would, certain platforms will get shut down, and then next that will get restarted, this will get shut down. So it will cause some let's say fits and starts on the oil production in the North Sea if the strike carries through.
Okay. Yeah. I mean, that's certainly one to watch. More supply disruptions. I mean, for me, it's all going to be about what the final Q4 GDP numbers look like. The UK's marginally avoided a recession. Most of the world seems to be. So, I mean, it depends what happens with say non-farms. Initial jobless claims are coming out this week as well. We've still got high inflation, but we've got strong numbers in employment growth. So what does that mean, and how does that translate to Jay Powell and his cronies and what they do? And is it? I think that the one thing to watch this week is going to be what happens tomorrow with Deutsche. I don't see that story going away. That really sent the shivers through the market on Friday. Oh no, not another one. I mean, that story's been there a while as well. But yeah, look, I think it's keep an eye on a banking crisis, what's happening there. That's going to affect market sentiment. And then, the geeks among us, and you are plenty, look at what's happening with jobless claims and the GDP numbers. But yeah, I think 70 to 80 is probably the new range that Brent could find itself in for a while, I think.
I think we can still test below 70. Still holding those cards to my chest on that one, but we'll see. And of course, in 2 weeks, we've got another OPEC meeting of the JMCC. So we'll see how that one plays out as well. But I think that's all the time we have for this episode of the Smoking Barrel. I want to give a special shout out to Irene Ammo, our executive producing.
She holds it all together.
Program. So big shout out to her.
She is. Yeah, totally agree.
And if you haven't done it already, please like and subscribe and comment as you see fit. And look forward to talking to you all next week on the Smoking Barrel.
Ciao, ciao.